With just one announcement on April 2, 2025, President Trump didn't just target Venezuela, he unintentionally detonated the entire global oil market. A 25% tariff that seemed aimed squarely at the Maduro regime ended up, within days, collapsing U.S. oil exports, driving WTI prices below survival thresholds, and plunging the American energy sector into chaos. Was this a strategic sanction? Or the beginning of an oil disaster bearing America's name? April 2nd. There was no explosion, no convoy of armored vehicles, not a single oil rig burst into flames in the ocean. But on the morning of April 2nd, 2025, a political detonation still occurred, silent yet violent, from the desk of the President of the United States. With just one post on Truth Social, Trump triggered a global chain reaction, a 25% tariff on any country purchasing oil from Venezuela. The stated target was the Maduro regime, but the real consequences, swift, deep, and widespread, struck directly at the heart of the American energy sector. This wasn't the first time U.S. foreign policy took the path of sanctions. From Iran to North Korea, Washington had grown accustomed to using economic blows to exert geopolitical pressure. But Venezuela was no longer the hotspot it had been in the previous decade. Since most international oil companies had pulled out of Caracas, global supply chains had quietly adapted to the new reality. And just when dependence on Venezuelan oil no longer seemed like a strategic threat, the U.S. chose to pull the trigger. Trump called it Liberation Day, a declaration of economic and moral sovereignty. But in financial markets where every click can be worth millions of dollars, that declaration didn't feel like freedom. It looked like an earthquake. In less than 48 hours after the announcement, WTI oil prices plunged. Futures contracts were dumped, and phones rang nonstop in Houston, Dallas, and Midland. No one could explain why a strike aimed at Venezuela caused U.S. oil exports to drop by 94% in just a few weeks. But everyone could feel it. This was no longer about Venezuela. The reason lay in something no tweet could control: market confidence. Countries threatened by the tariffs were forced to seek new oil sources. But oil markets aren't like buying vegetables at the corner store. There's no instant replacement. And so, in a race to avoid Venezuelan crude, the world suddenly crowded into the same door: tariff-free sources, including the U.S. Instead of creating scarcity and driving up prices, the move had the opposite effect: oversupply, falling prices, and widespread disorientation among investors. The irony was stark. A policy born to bleed Venezuela ended up landing a punch on the jaw of the U.S. shale oil industry, the very sector Trump once hailed as the cornerstone of American energy independence. U.S. companies weren't wrong in strategy. They just couldn't predict that a grand game they didn't even join would knock them off the board. A sharp drop in exports wasn't just a revenue hit. It was a signal that in a world where energy equals power, that power can self-destruct with just one unilateral policy. No one objected to tightening the screws on Maduro, but the painful question remained: what's the price, and who's truly paying it? In the early days of April, oil ports from Corpus Christi to Galveston went still. Shipping contracts were canceled. International investors pulled out. The rigs didn't shut down, but they didn't ramp up either. The shale industry, long used to price volatility, now faced something even more terrifying: unpredictability. Throughout the political history of U.S. oil, from the shocks of 1973 to the boom of 2009, the most vital element wasn't high or low prices. It was the ability to control the rules of the game. But on April 2nd, Washington did what markets never forgive. It rewrote the rules overnight, with no warning and no impact assessment. And the aftermath of a day without guns or smoke, but filled with tremors, is still rippling outward. From the gas station pumps on the boulevard to the payrolls of gas field workers in Texas. This wasn't just a tariff decision. This was an economic tsunami, set off by a single push of a button, when power becomes a burden. In the moment when tweets about Venezuela tariffs were still fresh on phone screens, a quieter yet more forceful wave began to rise from the deepest layers of the global energy supply chain. Not from OPEC, not from Beijing or Moscow, but from the logistics offices, refineries, and trading floors of Houston, Rotterdam, and Singapore. And the irony was this: the first victims of President Trump's so-called economic liberation were the very U.S. oil producers he had once promised would be the backbone of American energy independence. In theory, banning countries from buying Venezuelan oil meant forcing them to turn to other suppliers, including the U.S. But the market doesn't operate in a straight line. When countries from India to South Korea were pushed out of Venezuela's orbit, they didn't automatically choose the U.S. Instead, they turned to the Middle East, North Africa, even smaller but more agile suppliers in Eastern Europe and West Africa. And in that instant, American oil, once considered powerful, suddenly became excess. This phenomenon spread like a chain reaction. Without stable destinations, oil tankers began to slow down, even get canceled just before docking. Meanwhile, American crude kept flowing from Permian and Bakken fields, because the extraction machinery can't just stop overnight. And so, millions of barrels began to have nowhere to go. Storage tanks in Cushing, Oklahoma quickly filled up. Transport companies received requests to delay shipments, and energy investors fled. But the issue wasn't just inventory. The real problem was the breakdown of trust. Countries that once signed long-term contracts with the U.S. began to reconsider. Should they tie their energy future to a country that can change the rules with a single executive order? Refineries that had based investment plans on stable supply from Texas or New Mexico now had to recalculate policy risk, supply chain risk, political risk. This created a paradoxical spiral. The more America tried to show strength, the more the market avoided that strength. The impact on domestic businesses was immediate. Upstream companies lost orders. Refineries lost profit margins because they didn't dare stock up as oil prices swung wildly. Banks postponed disbursement for new energy projects because they couldn't calculate break-even points. And worse, international investors began reshuffling their portfolios, reducing exposure to U.S. energy assets. Not because they doubted the technology or output, but because they doubted the policy. Over the past 2 decades, the rise of U.S. shale wasn't just thanks to fracking technology or reduced costs, but also due to something rarely discussed: the belief that America was the most stable energy market in an unstable world. But now, as Washington uses oil as a strategic weapon, that definition of stability is beginning to crack. Formerly loyal customers of American crude, drawn by its quality and predictability, are now turning to partners seen as less unilateral, even if the price is higher. Of course, from the White House's perspective, this was still seen as a strategic squeeze, a tough play against countries still engaging with the Maduro regime. But for energy executives, it was a disruption no one was prepared for. No one opposed the U.S. defending democratic principles. But no one wanted to be the sacrificial pawn in a chess game where markets were treated as just another variable. And that is the tragedy of unchecked power. It doesn't just cause short-term damage, it erodes the long-term foundation of trust. In a global economy where every container moves by algorithm and every contract is priced by the second, uncertainty is no longer just a risk, it's a sentence. And in April 2025, the market read that sentence clearly, by turning its back on U.S. oil, not because it wasn't needed, but because it was no longer a safe bet. The survival threshold. Crude oil prices are not just numbers in financial news. For companies drilling deep into the ground of West Texas or the plains of New Mexico, they are the thin line between life and death. And in the early days of April 2025, that line was broken. Within just 1 week after the tariff on Venezuelan oil was enacted, the price of West Texas Intermediate, WTI, the main benchmark for U.S. crude, plunged straight below the $60 per barrel mark. For consumers, that might be good news, but for shale oil producers, it was a nightmare, because most of them need oil prices to stay between $60 and $65 just to break even. Below that threshold, every drilling, extraction, transportation, and processing activity starts losing money. And losses in the oil industry are not like in other sectors. This isn't a business that can pause and then resume once things stabilize. Every well is operated under an investment plan approved months, even years in advance. Money has already been spent on equipment, labor contracts, emission systems, environmental commitments. When prices drop below survival levels, companies don't just lose profits. They are trapped in a stream of ongoing costs with no exit. In executive boardrooms in Midland or San Antonio, the atmosphere shifted from cautious to urgent. Financial charts were no longer forecast curves. They became countdowns. How long until we run out of cash? Some companies immediately halted drilling new wells. Rigs that hadn't yet launched were put on indefinite hold. Projects that were ready for investment had permits withdrawn, and in many places, waves of layoffs quietly began, not with press releases, but with contract freeze emails and short calls from HR. The difficulties didn't stop at operations. On a deeper level, financial risks began knocking. Before the oil crash, many companies had used derivatives to hedge, but now risk insurance costs soared. Banks that had been willing to lend when prices were stable began demanding larger collateral or imposed lower credit limits. For small firms, already limping through the post-COVID phase, this blow was unbearable. Some filed for bankruptcy in silence. Others quietly sold off assets to larger corporations on the lookout for expansion opportunities during a bleeding market. But the most bitter part lay elsewhere. This collapse didn't come from normal market forces, wasn't due to global oversupply, nor a sudden drop in consumption. It stemmed from a political decision, with no prior roadmap, no specific impact assessment. For U.S. oil producers, this was worse than a price shock. It paralyzed their ability to plan. Because when prices fall due to geopolitics, no one knows where the bottom is. And when prices recover, not due to supply and demand, but from a temporary exemption from the White House, no one dares trust that rebound. The market no longer relies on technical indicators or fundamental analysis. It runs on government signals, where a single tweet can wipe out billions in market capitalization within minutes. For large corporations, this disorientation may be an opportunity. They have legal teams, risk departments, and the ability to shift capital quickly. But for independent producers, the ones running operations from a small office, personally tracking every barrel leaving the pump, this is a survival crisis. The very people once seen as the backbone of the American energy revolution are now the first casualties of a policy stamped freedom. By the end of the month, a saying was circulating at oil industry conferences. We didn't lose to the market. We lost to our own policy. And as WTI prices continued hovering below survival thresholds, no one dared commit to long-term investment. Trust had been broken, and in the oil industry, that's the one thing you can't pump back up: the half-measured rescue. On April 9, 2025, exactly 1 week after the strategic strike on Venezuela sent U.S. oil prices into a tailspin, President Trump stepped in front of the cameras with a different tone. No more hardline declarations. No more slogans about Liberation Day. Instead, he announced an adjustment, a temporary suspension of the 25% tariff on countries importing Venezuelan oil, except China, for 90 days. To the market, that message felt like slamming the brakes on a downhill slide. And indeed, within just hours of the announcement, Brent crude prices rebounded above $65 per barrel, and WTI recovered to the $62 mark. Trading boards at ICE lit up green again, but behind that temporary stability was a much more complex reality. Because what the White House had just issued was not a strategic correction, but a political patch. That pivot triggered three clear reactions. The first was a sigh of relief. U.S. producers, shippers, and refiners immediately had more time to reassess. Shale companies paused their layoff plans. Investors stopped pulling out. Some rigs that had been on hold were left on standby. But all moves were cautious, because everyone understood 90 days is not enough to erase the fear that everything could change again with just one more tweet. The second reaction was confusion, not because of the tariff level, but because of the inconsistency. Why was China the only country not granted exemption? Was the Venezuela ban just an excuse to escalate the U.S.-China trade war? Allies like India, Japan, and South Korea, countries that had scrambled to avoid Venezuelan oil, were now unshackled, but unsure if they'd be chained again at any moment. This uncertainty made both national and private oil companies hesitant to sign long-term contracts with U.S. suppliers, as no one wanted to get trapped between sudden policy shifts and a chaotic market. And the third, the bitterest, came from China. Left alone outside the 90-day safety zone, Beijing saw this as discriminatory policy and immediately retaliated with a tariff package targeting a range of U.S. energy and industrial equipment exports. State media labeled Washington's new policy the weaponization of market chaos and warned that China's trust in U.S. energy supply was over. As a result, while oil prices experienced a modest recovery, the strategic landscape became even murkier. U.S. companies didn't know whether to expand or retreat. Foreign partners didn't know whether to hold contracts or walk away before the exemption expired. Market analysts stopped looking at supply and demand. Instead, they speculated on what might happen in the next presidential press briefing. The scariest thing in a commodity market isn't low prices. It's uncontrollable uncertainty. And that is exactly the legacy this half-measured rescue left behind. 90 days isn't enough to restore supply chains, not enough to rebuild trust, not enough to convince investors that America is acting according to a predictable logic, and certainly not enough to hide the truth that the entire global energy market was just manipulated by a policy that had not been tested, had no safeguards, and came with no guarantees. Inside executive offices in Dallas, Houston, and Calgary, one question repeated endlessly: what happens after 90 days? No one had an answer. Every plan had to be written in pencil, always with a side note: subject to policy developments. That is not how an energy superpower operates, but that is how the United States in 2025 is rewriting its role on the global energy chessboard, with temporary patches, not long-term strategy. And as the 90-day countdown began, the market understood clearly. This is not a time for recovery, but a pause before the next storm. The game of short-term winners. The energy market was once built on fundamental rules: supply and demand, production costs, and the stability of trade flows. But after the earthquake called the Venezuela tariff, those old rules were completely overturned. Instead, the market fell into a dangerous game, where each political decision became a roll of the dice and every trading session was a bet without insurance. From New York to Singapore, trading floors suddenly turned into psychological battlegrounds. When a tweet from the White House could cause oil prices to drop 6% in a morning and rebound 4% just hours later after a press conference, traders no longer invested based on outlook. They speculated based on fear and reflex. The second quarter of 2025 recorded a trading volume record on the ICE exchange. Over 219 million futures and options contracts executed, far surpassing the previous quarter's 181 million. That wasn't a sign of confidence. It was proof of an economy running on adrenaline. This mindset quickly spread from the financial floors to real-world businesses. Oil producers, forced to survive amid irrational price swings, began hedging at all costs. They bought more expensive hedging contracts, accepting thinner margins just to keep cash flow alive. But that also meant all long-term plans, opening fields, building refineries, investing in infrastructure, were either frozen or indefinitely delayed. Meanwhile, banks, seeing risk rise, began tightening credit conditions. They demanded larger collateral, raised risk insurance fees, and reduced lending limits for the oil and gas sector. For mid-sized and small companies, especially in states like North Dakota or Colorado, this was a fatal blow. It wasn't the market that brought them down. It was the cost of protection from the very financial system that once served as their support. On the flip side, large hedge funds and global energy corporations, equipped with their own trading desks, real-time data, and billions in managed assets, took full advantage of the chaos to profit. They didn't need oil prices to rise, they just needed to predict the direction of volatility. A well-orchestrated press conference, a leaked memo from Washington, or a semi-official news tip from Beijing. All were enough to create price waves big enough to ride for quick profit. And so, the oil market, once described as the lifeblood of the global economy, has now been turned into an underground casino for high-speed players, those who produce real value. Drillers, pipelines, engineers, truckers have been pushed to the sidelines, and the ones reaping rewards are those who can read the trading signals, sense the mood at the White House, and dare to place big bets. What's unfolding doesn't just reveal a vulnerable market. It exposes a more frightening truth. When policy is written to the rhythm of politics, the survivor isn't the best. It's the fastest. And in this game, the cost isn't just financial. It's the loss of the very foundation of stability on which global energy has been built for decades. The machine is slowing down. Oil has long been more than just a source of energy. It is a health indicator of the global economy. When factories are running, trucks are moving goods, planes are taking off, and ports are full of containers, oil demand rises. But by the second quarter of 2025, right in the middle of a policy storm, something strange happened. Supply was abundant, but no one really needed it. According to data from the International Energy Agency, IEA, global oil demand growth fell to its lowest point in years. Not because of war, not because of a financial crisis, but because of a series of economic uncertainties spreading from Washington to Beijing, from Berlin to Jakarta. Logistics companies cut back on fuel orders because they weren't sure if customers would need deliveries the following week. Factories slowed production because they didn't know if supply chains were still intact. Airlines canceled flights because passengers postponed travel plans in the face of fuel price volatility that changed by the day. When policy uncertainty becomes the dominant force in the market, businesses react with survival instincts: reduce, delay, and wait. But this leads to a terrifying spiral. The more they wait, the more demand shrinks. The more it shrinks, the more prices fall. And when prices fall, investment is postponed. A vicious cycle that's hard to escape. At major oil storage hubs like Cushing, Oklahoma, or the Gulf Coast ports, Inventories began to soar. Millions of barrels of oil, not consumed as planned, were held in giant tanks that had already been full for months. But oil can't sit there forever. As storage space ran out, producers were forced to dump it, even knowing they were taking a loss, just to avoid storage fees or degradation from declining quality. Even more ironic was the return of contango, when future delivery prices are higher than current spot prices. This had appeared during the COVID-19 crisis in 2020, but now it was back not because of a pandemic, but because market confidence had been eroded to the core. In that condition, people no longer believed in present prices. They only bet that the future might be better, even if no one knew how. Worse still, the imbalance between supply and demand led to price distortions in different regions. In Asia, where importers began looking for non-U.S. sources, Middle Eastern oil prices sometimes rose against the general trend. In Europe, refineries lacked the specific crude types suited to their technical setups due to sudden supplier changes. The result? Consumers didn't benefit from falling oil prices. Instead, they saw gasoline prices rise because of higher transport and blending costs, a paradox that confused both the market and the public. Cheap oil, yet expensive. And it all stemmed from one thing: trust being pulled out of the market. Not because of a lack of oil, but because of a lack of predictability. No one could be sure if tomorrow's policy would reverse today's. No one knew if a single tweet could send oil prices up to 70 and crashing down to 55 within a single trading session. And when the market loses the ability to read the future, it also loses demand, because no one wants to buy fuel for shipments that may never depart. That's when the global machine, once powered by the steady rhythm of oil-driven growth, began to emit the screech of friction. Not because it was broken, but because people no longer dared to press the gas. The retreat on the black gold lands. As demand stagnated, trust collapsed, and the market wavered with each tweet from the White House. The place that felt the pain most wasn't the international trading floors, but the very lands that once built the American shale oil dream. In Texas, New Mexico, and North Dakota, where the sounds of drilling rigs and tanker trucks once filled the air, the summer of 2025 brought with it the heavy atmosphere of a retreat. The rigs slowed down, then stopped entirely. Some small companies dismantled equipment before lease terms expired. Technical staff, once courted with six-figure salaries, now received layoff notices one after another. From the Permian Basin, the heart of the shale oil revolution, to the oil fields of Eagle Ford and Bakken, the echoes of boom times were replaced by emergency meetings and budget-cut spreadsheets. According to a report from the Dallas Federal Reserve, the Oil and Gas Activity Index in the second quarter fell into negative territory for the first time in 3 years. That means the number of companies shrinking, cutting back, or halting operations outnumbered those expanding or investing. This was no longer a short-term adjustment. It was a strategic shift in defense mode, reflecting an industry that once believed in a growth cycle now learning how to contract just to survive. In reality, many companies had already prepared budgets for a difficult year, but no one foresaw the shock that came from policy uncertainty. A refinery contract canceled, a loan frozen, an exploration campaign shelved because hedging costs had doubled. And so, the wells, even those fully permitted, staffed, and equipped, still had to wait in silence. In towns like Midland or Hobbs, whose livelihoods depended on the extraction industry, the ripple effects spread in waves. Motels saw fewer guests, restaurants closed early, equipment suppliers quietly moved inventory to other states. Technical colleges no longer enrolled students like before. Young engineers, freshly graduated, were caught between energy theories and the reality of unemployment. What once seemed like an unstoppable golden era had entered a state of technical hibernation. But the scariest part is that no one knows when they'll wake up. Because this is no longer just a matter of oil prices, it's a matter of sentiment and policy. Even if oil prices temporarily recover, no CEO dares to hit expand if one executive order tomorrow can overturn an entire financial model. No one wants to pour capital into an industry where every step forward faces political risks greater than geological ones. And like every energy crisis before, the weakest players are the first to exit. Small companies, lacking cash reserves or flexible hedging tools, were silently eliminated from the game. They sold off drilling permits, canceled land leases, or in many cases, let the assets sleep quietly underground, because maintenance cost more than letting them lie dormant. To outsiders, this downturn may seem like just a correction phase. But for those who had placed their careers and lives into this land of black gold, it was a wake-up call. That strength lies not in reserves, but in the ability to foresee the future. And in the summer of 2025, that future, in America, was no longer measured in barrels of oil, but in each line of a political news brief.